It's 8:31 a.m. Eastern. Thank you very much. Welcome to FX Street. My name is Adam Rosen. I love Ed. He's the best. We have a very fun topic, as always, to talk about today. We're going to talk about trend and counter-trend trading strategies. When we talk about a trending market, talk about a market like the Dow Jones Industrial Average. We're looking at the futures chart right now. We can talk about currency pairs like the Aussie dollar, to a lesser extent, pound dollar, euro dollar. These are markets that are considered trending markets because they consistently over time make higher highs or lower lows. The opposite of the trending market would be the range-bound market. That's a market that fails to make higher lows. And we have different approaches, different strategies that we would employ depending on what market condition. It's something, I think, that it's a dynamic that's very, very important to learn in terms of trading the foreign exchange market. It's trading any market. If we're trading a trending market, there are certain strategies when we want to use. Specifically, the trend is your friend. You only want to trade in the same direction as the market as the overall trend when we're in a trend. And we should not try to pick tops and bottoms. It can be a very, very dangerous and very, very costly endeavor. However, in a range-bound market, we can look for tops and bottoms, and we can employ, like the old commercial says, a buy low, sell high again and again type of strategy. Well, we're going to do our best to identify those range-bound trending markets and the appropriate strategies to trade both of them. Now, in some of our other webinars where we discuss the fundamentals of the market, we discuss how to identify those currency pairs those currency pairs that are best trending, putting those two currencies together, one that's moving down and one that's moving up. And that creates a trending market condition, like the Aussie dollar, like the Aussie yen. Now, when we talk about range-bound markets, we talk about a currency pair where both currencies are kind of moving in the same direction. Generally speaking, we're talking about currency pairs like the dollar CAD, for example, or historically, we're talking about currency pairs like the euro pounds. Generally speaking, now, it's a little bit difficult to say always, but generally speaking, what we're looking at in terms of a range-bound currency pair is a currency pair where both currencies are derived from the same geopolitical economic background or have the same geopolitical economic background, like the euro and the pound, or the euro and the Swissy, or the pound and the Swissy. When you have two currencies in the currency pair that sort of react to the same news in a similar way, those currencies tend to move in the same direction, like the euro and the Swissy. What's good for the euro is good for the Swissy, and vice versa, also the pound. But when you take a look at the Aussie yen, the Aussie has extremely high interest rates, the yen has extremely low interest rates. So when we enter a period of strong stock market prices, and there's a lot of optimism in the economy, we tend to buy the higher yielding currencies and sell the lower yielding currencies. That's why Aussie yen historically is so trendy and euro pound is so range bound. Let us take a step back. So that's a little bit fundamentally in terms of mechanics. How do we identify what currency pair is most likely range bound and what currency pair we expect fundamentally to be range-bound and trending in the near-term future. Technically now, and that's, like I said, that's a topic that we discussed quite heavily in some of our other webinars. But today, let's talk about how do we identify these currency pairs technically, technical analysis, reading the charts, and how do we employ the right trading strategy? Well, take a look at the following chart. It's the Dow Jones Industrial Average. The symbol is YM. This is a trending market condition. This is a market that tends to make higher highs or lower lows. Now, like I always like to say, inside every range-bound market is a trending market, and inside every trending market is a range-bound market. Over the long term, we can draw lines, and this is really the first step to identify, is this range-bound or trending? Draw lines connecting the significant lows that would become supports. Resistance typically is parallel or oftentimes is parallel to supports, and that connects to significant highs, and we can sort of adjust these lines to encompass the most recent trading action. I like to connect the lines with the highest highs and the lowest lows, including the long candlestick wicks. This is a trending market condition by far. Now, you can see over the past 3 or 4 days, well, the market hasn't really made higher highs or lower lows. On a smaller time frame, and by the way, this is a daily chart, on a smaller time frame, then we could go to, for example, a 1 hour, this would be considered a range-bound market. A range-bound market is a market that does not make new highs or new lows, but in fact stays within its trading range. So it really all depends on the time frame that we consider when we talk about range-bound and trending markets. Is the Dow Jones Industrial Average trending? Yes. On a daily chart, basis, yes, it is trending. On a 1 hour chart, it's range-bound. And basically, essentially, the time frame that we choose, that we select, we should stay to that time frame. We should stick to that time frame, because if we all of a sudden change a time frame, then our trading strategy completely changes. You know, how many times have we bought something based on a 1 hour chart and we say, well, you know, it looks good, or, you know, better yet, in this case, the Dow Jones Industrial Average, the previous candlestick hit this resistance, kind of looks like a nice reversal. We did not break the previous highs up to 11/14/23, going back to November 5th. And a range-bound trader would say, hey, I'm going to buy low and sell high, and that's a good way to go, and I'm going to sell short here. Well, if we would have sold short, maybe we didn't get the best price. All of a sudden, you know, we start to doubt ourselves, and we say, well, let me take a look at this market on a different time frame. Say, well, on a daily time frame, hey, this looks really strong. And then you start to ask yourself the question, why did I sell short? I should try to buy. And looking at this chart, well, you know, it would be very easy for me to convince myself it's not a good idea to sell short. I should cover the trade, get out of my trade, and maybe even go long. So it really all depends on the time frame. And that's a very, very easy way to trick ourselves into getting out of trades prematurely, to taking losses when we shouldn't. If we take a trade based on a 1 hour chart, stay to that 1 hour chart. Now, before we actually press, you know, the buy or sell button, I think that it's important to go through all the different time frames, from large time frame to small time frame, in that order, starting with the large time frame, you know, to completely analyze what does a chart look like, what is the overall chart telling me. So although, in terms of the Dow Jones Industrial Average, although a range-bound trader would say, hey, yeah, it looks like a good place to sell short, yeah, maybe, but I don't like to trade against a long-term trend. And the long-term trend in the Dow Jones Industrial Average is definitely to the upside. So even though the 1 hour chart looks like a good short position, the longer time frame always overrides the shorter term time frame in terms of precedence, and therefore I would not want to sell shorts. I would not want to trade against the trend. Let's first take a step back and try to identify how do we really know, is it a range-bound or trending market? Now, the first step is I like to draw these support and resistance lines. Generally speaking, if we make higher highs or lower lows, that is a trending market. And again, going back to the 1 hour chart, we did make low lows slightly, but we did also make lower highs, and we also did make lower lows. But clearly we can see the difference. The angle of ascent or descent has to be pretty significant in order to be a trending market. This angle, I'm approximating, is around 45 degrees. Now, there's not one exact degree or angle that I would say that's the cutoff. Technical analysis is a little bit of an art, a little bit of a science. But I think when we're trading the foreign exchange market, we have such a huge advantage because we have the opportunity to identify not only is it trending, but what is the best trending currency pair and what is the least trending currency pair. So if we find a currency pair that sort of has a trend, but it looks like it's a little bit of a range-bound market and a little bit of a trend, I'll step aside and I'll look for another currency pair to find the one that's absolute most trending or absolute most range-bound. In one of our other webinars recently, I've talked about this a few times. We go through a simple exercise of trying to identify the best trending currency pair, technically by comparing the RSI indicator on different currency pairs. If you recall that webinar, that's exactly what I would apply to doing so now. It's a little bit of a lengthy process, so I don't want to eat up too much of today's webinar's time. But essentially, what we want to do is try to identify the strongest trending currency pair if we're looking for a trending market. Now, how do we do so? First of all, support and resistance lines. Now, we can also employ a number of different technical indicators. Which one you choose is certainly up to you, but I would try to stay consistent. We can talk about something like the RSI, the Relative Strength Index. This measures the relative strength of the market on a scale of 0 to 100. And by the way, after I get done with the Dow Jones Industrial Chart, then we'll jump to the currency pair. So if there's any particular currency pair you want to see where we can actually identify, is it range-bound trending and then the appropriate strategy, chat it in, and we'll get to it right away. The RSI shows us very trending market conditions when the line is above 70 or below 30. Above 70 shows us we're very overbought. Below 30 shows us we're very oversold. Now, we can see that the market technically was trending for quite a while, and the RSI really remained between the 30 to 70 level, and the angle of ascent or descent was really not that significant. It shows us a slow, steady trend to the upside, but not a very, very fast-moving market. Expect a lot of pullbacks, which in fact we did. We went up a lot, down a medium amount. Up a lot, down a medium amount. That's not really a strong trending market, the Dow. It's a steady trend to the upside. When the RSI does in fact cross above 70, it shows, and this, by the way, measures the 14 previous candlesticks. So when the 14 previous candlesticks really start to move the clip to the upside, at a nice clip to the upside, then all of a sudden we see the line cross above 70. Now please be aware that the reversal signal that we look for when we're using the RSI Relative Strength Index is for the currency line, or not just the currency line, but the RSI line to cross above and back below 70 or below and back above 30. So the moment we cross above 70 shows us the market's really trending to the upside, but the more trend that develops, the closer we are to its eventual reversal. We then crossed above 70 again. Most recently, we did so, this is November 4th, just the other day. Last week we had a really, really strong day. This sent the RSI back above 70. Daily chart. So first step in terms of the RSI is go to a daily chart and note if the RSI is above 70 or below 30. Now, it's not an absolute requirement that's above 70 or below 30, but I think it does serve as a very good reference point. If we are above 70 or below 30, it shows us the market is really moving very, very fast, and we should absolutely look for only those trending market trades, meaning the trend is your friend. Only look to go long the Dow. As tempting as it is all the way up to say, well, we've gone up this much, and long candlestick wicks, and it looks red, and it's maybe a double top, and we're going to look for a reversal, the trend is your friend. For whatever fundamental reason, there is a trend, and we should always honor that. There's trillions of dollars at stake that's sending the Dow higher for whatever reason. Some conspiracy theorists will say that the Chinese government is buying U.S. stocks to hedge their bond investments, their investments in U.S. bonds. Others will say, well, it's a massive short covering. Others will say, well, it's because of the very low interest rates in the U.S. It's encouraging a lot of foreign investment. Well, that doesn't really make a lot of sense. But whatever the fundamental reason, sometimes we can identify it, sometimes we can't, but the trend does exist. And when it does exist, it's certainly important to honor that trend. Now, that's the RSI. There are other technical indicators that we can use to identify the trend as well. We can take a look at something called the ATR. This is the average true range. Goes back on a period of 14 candlesticks as well. And very, very simply, what it does is it measures the candlestick, the length of the candlestick from low to high. Now, the candlesticks, the way we read them, is a thick part of the candlestick, the body, measures the open to the close. The long wicks, these long lines, represent the low to the high. Now, it's a little bit more of a complicated calculation, but essentially the ATR measures to show us over the previous 14 candlesticks, are the candlesticks getting bigger or smaller? In in a trending market condition, candlesticks tend to get bigger. Candlesticks get bigger as we make new highs or new lows, and the buyers tend to overwhelm the sellers, or the sellers tend to overwhelm the buyers. In the range-bound market, when the buyers and sellers move back towards an equilibrium, the candlesticks get smaller. And we can see, over time, as the market really developed a nice trend to the downside, the ATR rose to the upside. Now, the ATR turns back to the downside as we reach more of a trending market condition, a range-bound market condition, and in fact did not turn into a trending market condition again until the ATR started moving to the upside. So the ATR is the average true range. It's not a directional indicator. The RSI will show us if the market's going up or down. The ATR just very simply tells us are the candlesticks I should say, getting larger or smaller. Let's put the two together now. Putting the RSI alongside the ATR, we can start to really identify those extreme trending market conditions. Let's try to identify those market conditions that took place when the ATR was rising and when the RSI was also above the 70 level. Well, this helps us really all of a sudden start to limit what we're looking at. The RSI, let's draw these lines as follows. Draw horizontal lines. This is a good way to do so. And this is, again, on a daily chart. Now, because we're doing this analysis on a daily chart, does not mean we're going to use daily charts to actually enter the trade. But we're going to use the daily charts to identify what exactly is going on. Now we can zoom in and we can see, I just drew horizontal lines, vertical lines I should say, at the point when the RSI was above 70. Now we can see over time the ATR was actually declining, so it does not show a very extreme level in terms of the ATR itself. Question is, RSI rise above 70 indicates overbought? It does. It indicates it's overbought, but overbought, it's a little bit deceiving because overbought does not necessarily mean it's going to go down. Sometimes you'll see the RSI move to 80, sometimes to 90, sometimes much, much higher than that. Look to a 4-hour chart here. Try to get a good example of what we're looking at. We had a really strong day last week in terms of the Dow Jones Industrial Average. ATR hit levels up at 79. So if we had sold short the market when we hit 70, well, we then would have, obviously been on the wrong side of the trade because the market went up much further. The actual signal to sell short, to reversal back to the downside, is when the line crosses above and back below 70, or below and back above 30. Now, this above 70, it indicates there are trends that do exist when the RSI is between 30 and 70. I would not necessarily wait for the RSI to be above 70 before indicating the trend, because we can see on a daily chart, drawing the uptrending support line, we started that support line going back to September 8th of this year. The RSI did not cross above 70 until going to October 12th. And then again, the RSI did not cross above 70 until November 4th. We would have missed this entire amount. However, the RSI shows us extremely trending markets, extremely fast markets, and markets that are very likely to reverse in the near-term future. So I would not use the RSI to identify the trend, but rather the extreme trend that is likely to reverse. It really measures the last part, or will identify the last part of the trend. Trends exist much before the RSI crosses above 70 or below 30. However, I think the ATR can be used quite effectively to identify the trend as well. But notice again, the Dow Jones Industrial Average, it's not a really perfect trend, because as the Dow is moving higher, the ATR was declining. Shows us the market was trending to the upside, but it was not a very exciting trend. Now, we can still make money. Knowing this trend occurred, if we had bought, certainly we would have made money going long. But imagine getting involved in these candlesticks, and we went up a lot and down a lot, up a lot and down a lot. The fact of the matter is, it gave us more of a chance to really lose money. Because if you bought something in a trending market, you expect to make money soon, and you expect the market not to pull back too much. This trending market that I would identify as a medium, strength trending market, really is a more dangerous market. A great trending market is when we buy it and then it immediately goes up, immediately our trade starts making money, and it never really pulls back to a point where we're losing a lot of money in the trade, and it almost immediately rewards us. A friend of mine used to say that, when you buy something, when you go into the market and you buy something, if you almost immediately start making money, if almost immediately you make those 2 or 3 pips and you cover your spread, and then you see the trades in the money 5 pips or 10 pips or 15 pips, you immediately start to feel good. That's a good sign. that's a good sign. It's a good omen that we made the right trade. If we buy something, we buy the euro dollar, and then all of a sudden, and we can't make that spread back, that 1 pip spread, and then all of a sudden within the next couple of seconds and minutes, we're down 5 pips, 10 pips, 20 pips, and it just feels like we bought it and it just has gone down since we bought it. Trust your feelings. Sometimes it's a sign that, well, we just didn't get in the right direction. Now, finally, so just to recap really, really briefly, because I want to touch on a lot of different currency pairs. But just to recap, when we look at the RSI will identify extreme trending markets above 70 and below 30. It is not necessary that we're above 70 or below 30 to identify those trends, but it's a good way to filter out those very, very big trades and also to be on the lookout for a possible reversal. Now, ATR, average true range, when the line is moving to the downside, it means the candlesticks are getting smaller. Candlesticks were getting smaller as we developed the trend to the upside. Notice the candlesticks got bigger as we broke out to new highs, which, by the way, is our fourth clue. We talk about support and resistance, RSI, ATR. New highs and new lows, which go along with support and resistance, making new highs and new lows, is very important. Notice how, when the market broke out to new highs, here's a vertical line, with first really big candlesticks to break out to new highs, that's when the ATR started to move to the upside. The candlesticks over time, and of course the ATR measures the trend over the previous 14 periods. But notice how when the market broke out to new highs, the ATR started to move to the upside. It is not so important the angle of ascent or descent or the nominal level where we are, because that will always be different. But rather just simply is the ATR going up or down. If the ATR is going up, the candlesticks are getting bigger, and it means the buyers are starting to gain more and more control. So on the day of September 24th, we had the RSI, well, it did not necessarily cross above 70. Did not do so. So it shows us the market was not extreme. But then again, that's good. Because if it did not cross above 70, it means we still have more room to go. The RSI is telling us there's a pretty good trend in the market, but it's not too extreme. The ATR is telling us, hey, the candlesticks were getting smaller. Now they're starting to get bigger. The trend line connecting recent lows tells us, hey, we're moving to the upside. We're making higher highs and higher lows, and that's good. And now we broke out to a new high, and that's very important because a new high tells us all of a sudden, throwing out all the other technical information, because frankly, all of us don't pay attention to RSI or ATR indicators. But aside from that, the fact that we made a new high, think about it, put yourself in the shoes of the buyer. Anybody who bought the Dow Jones Industrial Average, well, between going back to May 6th of 2010, May 6th of this year, May 6th through that breakout of September 24th, from May to September, any individual that bought the Dow Jones Industrial Average, and I would say the average amount of investors that bought stocks inside the Dow Jones Industrial Average Index on September 24th, over the past 4 or 5 months, most of those buyers are probably making money. Most of the short sellers are probably losing money. And again, think about it in terms of buyers and sellers. That really is what moves the markets. Buyers, we have more margin. We're not going to get stopped out anytime soon. We have more money to play with, more confidence, more reason to buy more. Short sellers, we're closer to our stop orders. We're closer to a margin call. We're closer to an emotional point of saying, uh-oh, I think this is not a good spot. It's not a good trade. Let me get out. Think about your trading account. If we make $500 and then $200 of profit, and $500 of profit, and then $200 of profit. All of a sudden on September 24th, for the first time in a long time, we see our trading account shows us $700 of profit or $1,000 of profit. That's really a good sign because now all of a sudden, for whatever reason, we're making a lot more profit than we did over the past 4 or 5 months. That things look good. Short sellers, we lost $300 in a trade. Now we have a floating loss of $500. We go back from 3 to 5, back and forth. And the next thing you know, now our trading account says a loss of $900. For the first time in a long time, we say, uh-oh, things look like they're getting worse. Those new highs and new lows, especially over time, are very, very important. It's great because we're seeing those very, very big new highs and lows on a lot of foreign exchange currency pairs these days. Do I use the ADX? Not necessarily, but you can. The ADX, by the way, is the average directional index. Is that the ADX? there are different ways to use this ADX indicator, and I won't go through it because it's a little bit more complicated, but it certainly can be used to identify range-bound and trending markets as well. So you can use it as well. I like to use a little bit more of the more simple approaches, ATR, RSI, and what we're finally going to cover over here, by the way, is MACD, moving average, convergence, divergence. Now, you don't even have to use all three, but if you do use all three, it's not a bad way to find further sources of confirmation. Now, the question is, what do I use for entries into a trending market? We're going to talk about that in 3 seconds. I know Dow Jones, your favorite, give some time for FX. Absolutely. I apologize. I don't mean to spend so much time on Dow. In fact, if there's any specific currency pairs you want to talk about, please chat them in. And what we'll do is we'll go to those directly. Let's, in fact, really briefly, okay, let's go to the Aussie dollar, and we'll talk about the MACD with the Aussie. The Aussie dollar, fundamentally, we've been talking about this for quite a long time, is really the perfect storm of currency trades because the dollar goes down for the same reason that the Aussie is going up. Australian dollar has very high interest rates. The dollar has very low interest rates. The Aussie benefits from high prices of gold, yet when gold goes up, the gold tends to go up as a hedge towards a falling dollar. Now we can see I'm having a little bit of a tough time finding a parallel resistance line to support. In uptrending markets, always start with support. In downtrending markets, always start with resistance. But so far, and we can even take away resistance, because support in an uptrending market is most important. First step, always draw our uptrending support line. This is a daily chart. Then I'm going to answer your question, Roger, how do we actually look for the entry? We're first going to identify this is a trending market condition. Uptrending market, connect the lowest lows, including the long candlestick wicks. This uptrending support line tells us, hey, we're in a trending market. Then we go to our other indicators like the RSI, Relative Strength Index, and we can see, well, at times it was a trending market, that's for sure. It was pretty extreme. We pulled back. Recently, we actually crossed above and back below 70. But the fact that we're not above 70 right now, it does not tell me this is range bound. This is still trending market. It means it's not extreme trending market, and that's okay. That means the market still has more room to go. If we were above 70, I would get more and more skeptical of the trend and more ready to anticipate a possible reversal. A reversal does not mean I would sell short the Aussie dollar, because remember, daily charts is a trend. The trend is your friend. So when we're above 70, I just look to take profits. That's all. Now, RSI tells us trend, but not extreme. Look at the ATR, the average true range. Are the candlesticks getting larger or smaller? Well, they had been getting larger for quite a long time. In fact, the candlesticks started to get a little bit smaller starting on November 3rd. But then most recently, and we'll really zoom into the most recent trading action, ATR has again moved to the upside. So number 3, after trend lines and RSI, ATR is telling us, hey, the trend is back. What's the 4th step we talked about? The highest highs and the lowest lows. We're at 101.56. The moment we get above the highest highs, which is 101.81 on November 5th, that means that we're going to have our 4th clue, our 4th clue that in fact we're again in a trending market condition. No, we already are in a trending market condition. It's a confirmation that we are in a trending market condition. We don't want to go long once the market makes new highs. We already want to be involved in the trade. Now, 4th step to identify, or this is actually number 5, and you can take whichever one seems to make most sense to you. It's going to be different for everyone. MACD, moving average, convergence to divergence. This basically compares different moving averages. When I like to use the histogram bars, which are the yellow bars, and the histogram bars moving to the upside, it shows us, hey, the short-term moving average, which is the 12 exponential moving average, is above the 26 moving average, the 26 exponential moving average, and it's moving away from the 26 exponential moving average, and in fact, there is a trend. In other words, look for the histogram bars to make higher highs or lower lows in the same direction of the trend. We're looking for convergence. If the trend is to the downside, we want to see the histogram bars making lower lows. What we do not want to see is when the market's making higher highs and the histogram bars are making lower highs. This shows us a period of consolidation. Doesn't mean the entire trend is done, but for the time being, the market is pulling back. We want to see, again, if the market's making higher highs, we want to see the histogram bars making higher highs. So, trend lines, RSI, ATR, MACD, and also the market making higher highs or lower lows. These are all signs based on a long-term daily chart that the market is in fact in a trend. Trend lines tell us yes. The RSI tells us, yeah, we're at 70, so we're not really overbought, but yeah, there's a trend there. The ATRs turn back to the upside. The MACDs turn back to the upside. 5 for 5, this tells us, and the only other thing we're really waiting for is a further source of confirmation, is when the point that we make a new higher high. 101.81 is the highest high we've seen. We're 101.59, which by the way, and that's not 100% necessary. I mean, when that happens, we will then go to new highs we've not seen since the late 1980s. So very, very significant. Yearly highs are huge. 30-year highs are very, very huge. So Aussie dollar is a textbook example of a really nice trending market condition. Once we identify the trends, what do? This is what we do. We go to a smaller term time frame. I took away all the other indicators, by the way, and we go to a smaller term time frame. How small? Well, it really depends on our trading style, but we can look at something. Now, remember what we said earlier. 4-hour chart, I think, is a nice compromise of range-bounded trending. Now, this trend line, by the way, is a trend line that we drew based on the daily chart. We can still use this trend line to get into a trade. We can enter in a trade. It's at 98.19. That's where the trend line emerges right now. That means I would have to wait for a pullback to 98.19 on the 4-hour chart. That might not be, the best solution for a lot of traders, because that would require a 300-pip pullback. And the 300-pip pullback is not something we're going to get every day of the week. So the trend line is there. Be aware of the trend line, but it's not always going to provide the best solution. Go to a shorter-term time frame, and I'll show you a different technique, which sometimes can be very, very effective. We look for a moving average. Which moving average? The answer is the best one, and we can use either exponential or simple. It doesn't matter. They're very, very close in their indications. But whatever we use, try to stay to that one, just for a matter of convenience. Not convenience, but consistency. Now, I threw in just randomly a 26 simple moving average. Moving averages are meant to identify or really capture the overall trend. Now, what we want to do is custom fit the moving average to the market. Now, a lot of technical analysts will say we're curve fitting. We're looking for the moving average that worked the best in the past. I understand that, and I absolutely agree with you that we're looking for the moving average that worked the best in the past. All we're looking for is to identify what moving average worked the best in the past and hoping that it works one more time in the future. Doesn't mean it's going to work forever, but we're just looking for the moving average that worked the best in the past, and I'll show you how we do that. We can adjust the moving average. We'll change it from a 26 to a 50. What we're looking for, very simply, is a moving average in a trending market that connects the most. Let me zoom in here. This is a 1-hour chart, by the way. We're looking for a moving average that best identified, best captured the lowest low over time. This Aussie dollar chart, by the way, had a very extreme lowest low, so it's not going to be necessarily the easiest chart. We can see 50, by the way, is not a good moving average because the market was able to break down below the lowest low. Now, we could say, yeah, it did not close below this moving average. This is left to interpretation. Some traders will say, yeah, I don't care about the long candlestick wicks. I just want to see the moving average encompass the lowest low. But let's say we're a real stickler for detail, and we're going to change our 50 to a 70, and we can see here still a moving average was intersected by the candlestick wick. So we have to make the moving average longer. Move from a 50 to a 70, here's a 90, and just to be 100% accurate, let's go to 100. That's a little bit too much. In between 90 and 100 is 95, and 95 pretty much does the job. 95 moving average, which just measures in a 1-hour chart the 95 most recent candlesticks, was the moving average that best captured the market. The market came down, touched that moving average, and it failed to cross below. What we want to do is then buy the next time the market comes back down, tests or comes very close to the moving average, but fails to break below. The next time that took place was when the market hit 1.0074. That occurred on November 8th. That was just, yesterday. We were able to buy just right around, let's say, 101, just actually a little bit below 101. We're at 101.56 right now. We would place our protective stops below that moving average. A nice way to assume where the moving average, where the stops may be, is to very simply plug in a moving average with a longer term time frame, like a 120, and we'll change that to red, and that represents the stop orders. Now we see here the blue moving average is a 95, and that best showed us where to get in the market. And then the red moving average, I place a 120. Now there's no exact formula how much I use for the stop and limit. But we want to place our protective stop orders below the lowest low. In this case, the moving average or the stop order did hold us in there. Eventually, we would have gotten stopped out if we did not take profits. As the trade moves into profitability, a lot of traders, what they'll do is they'll move their stops to break even, and they'll move their stops to adjust them just below the moving average to do so. Let me get to some other currency pairs because I know there's a lot that has been requested. After the Aussie dollar, let's take a look at the Kiwi dollar. Let's go to a daily chart again. I'll very quickly run through the same exercise from beginning to end. First of all, uptrending support level connecting the lowest lows. Do we have a trending market according to support and resistance? We do. Notice, by the way, sometimes if a resistance is broken, it becomes a new support. So this is our new suspected support level. And I'll try to answer these questions as I'm throwing on these indicators. The next question is, and after the Kiwi dollar, I'll get to the pound dollar and Aussie yen. Do you see that the daily RSI negative divergence is significant on the Aussie? Going back to the Aussie really briefly on a daily chart, just to answer this question. Whoops. Then I want to get to the other currency pairs. RSIs under oscillators, relative strength index. We talk about the RSI divergence, convergence, the same way we talk about the MACD. What we want to see is the market, when the market makes new highs, the RSI also makes new highs, and the MACD also makes new highs. However, more recently what we saw was when the market was making higher highs, the RSI was going lower, and the MACD was going lower. So yeah, that is pretty significant. We want to see when the market makes new highs, the RSI is also making new highs, and the MACD is also making new highs. In terms of the Kiwi dollar, let's throw in. Now, by the way, the moving average that I use for the Aussie dollar turned out to be on a daily chart, a 1-hour chart, a 95 moving average was the one that best fit the lowest low on the 1-hour chart. Different time frame, different moving averages altogether. Going to the RSI, relative strength index, we're going to throw in also the ATR, average true range, and also, again, the MACD. There are so many different oscillators that we can use. I just wanted to give you a sense of how to use 3 of probably the most commonly used indicators. Now, going to the Kiwi dollar, trend lines tell us, yeah, market's trending to the upside. That's good. RSI, we were above 70. Actually, looks like we're kind of just about 69.81. RSI is telling us we're pretty strong trend right now. Over time, the ATR also moving to the upside, and the MACD histogram bars are also moving to the upside. 5 for 5, we're making new highs. The only other last piece of confirmation that's usually going to be the last sign would be the moment that we break above 79.72, going up to the highs of November 5th of this year. Do not wait again for new highs or new lows, because by the time you see those new highs and new lows, we will already have to be in the trade. Now, from that point moving forward, I went to a 1-hour chart. We're going to take away our indicators. We can use these indicators also for an entry, but I like the moving average entry. 1-hour chart, Kiwi dollar. Again, long-term support and resistance lines I'll keep on here on the chart because it shows us where the ideal entry is. But let's use the moving averages to find a more recent entry. Trend line, moving averages. Now what I want to do is show you, let's go back to a blue chart here. There we go. I want to show you how the moving average would have worked in the past. Take the previous lowest low. Well, let's go back to the lowest low. This goes back to November 2nd of this year, 76.33. This, by the way, is a 120 moving average. It is well below that lowest low. And I'll draw a vertical line to try to identify. And I didn't, by the way, rehearse these charts, so I hope this works. I want to adjust this moving average so it will match up with that lowest low. Let's go all the way down to a 50. That actually worked out pretty well. Wow, that was just a lucky guess. Sometimes you're getting a lucky guess. Remember, I drew the vertical line. Let's pretend we are here. That's where I drew the vertical line. Let's pretend we don't know anything that happened into the future. November 2nd, the market, this is the Kiwi dollar 1 hour chart. And of course, this is after we identified the long-term chart was definitely in the trend. That's for sure. Now, once we do so, then we look for the moving average that best fits this trend. Now, the moving average came down to a low of the lowest low is 76.32. The moving average is 76.31. That's not bad. That's 1 pip. What happens now? We buy only the next time. This moving average is only good for one more shot to try to get in. We always have to constantly adjust these moving averages. But the next shot to get in was this long candlestick wick that came down to 77.05. Moving average is 77.05. This lowest low, 77.08. Within 3 pips. Imagine buying at 7,700. Well, it went up to 7,900 very, very quickly. Now again, the moving average eventually failed because moving averages the market always changes. The angle of a centered descent always changes. So the moving average is only used for the next best trade. Now the market on a shorter term basis is moving to the downside, so we have to wait for a pullback. But assuming this is the new lowest low, let's drag my vertical line over. Let's readjust the moving average to see what we would look for moving forward. Let's use 150 moving average. I'm just guessing. That's it. Lucky guess. Actually, a little bit more than that. Let's take 155. Whoops. That's not it. Trend line, moving average, 155. That does have a good job. So we know now the moving average, 155 period moving average on a 1 hour chart, now shows the 78.16. Look for a pullback near the 78.16 level to go along the Kiwi dollar. Daily chart tells us a strong trend is in place. And what about the other 3 lows for the moving average? I assume you're referring to the Aussie dollar charts in terms of the 3 previous lows. If I understand your question correctly, again, what we're looking for in the moving average is only identify the most recent low, and we can adjust this low. Take away the red line. That's the other moving average. Let's zoom in now. Whoops. Okay. Let us zoom in. This is a 1 hour chart again. I'm going to take away the RSI, take away the MACD. And let's find the most recent swing low. Right now we're looking at a 95 moving average. We obviously have to make it bigger. 120, I'm guessing, not enough. A little bit more than that, 140, too much. I'm guessing 125. 125. A little bit more than that. I like to be perfect. 127. That's a good job. Okay. Aussie dollar 1 hour chart, 101.52. Currently, the moving average tells us we should wait for a pullback to 1.0081. Daily chart does confirm there's a nice trend at stake. Are you still thinking along the Aussie now? The COT shows that big boys are unloading. Yeah, the COT indicator is a completely different indicator. So I have used that in the past. I have not used it recently, but if you do use it, and it's not necessarily that you do, you do not, but if you do use it and there's another indicator showing you a little bit of a different story, well, then maybe it's best to step aside on the trade. Doesn't mean the trade's not going to work. But, more than anything, we should try to take those trades that best demonstrate all the pieces, tools of confirmation that we look for. Now, the red moving average is higher on the other time frame, on the on the other time frame. Now, the red moving average was what we use for our stop orders, and yes, when the market does reverse the other moving average, which we use for stop orders, here we use, what was the moving average? We used a 127, I believe. I will use a longer moving average to approximate where the protective stop should be placed. 127, let's say a 140, and we can see here, that's the blue. Let's make this red now. Red is here, and that would be approximately, just visually to demonstrate where the protective stops would be. Now, question is, do you ever relate divergence to low liquidity? It's yes, but over, not in terms of currency, how much liquidity is in the currency, because all currencies we trade, the Kiwi probably is the smallest amount of liquidity and the smallest amount of volume is still humongous. But in terms, I would identify yes and no. You know, in the stock market, I would say, yeah, when the market reaches a range-bound a pattern like this, yeah, we could say it's low liquidity. But in the foreign exchange market, remember, we're talking about two different currency pairs always compared against each other. So when the Aussie dollar comes back, it does not necessarily mean the market's slow. It just means that maybe the Aussie's strong and now the dollar's starting to strengthen, and you put two strong currency pairs together, or two strong currencies together, and you get a range-bound market. Case in point, the dollar CAD, which has been in an unbelievable range-bound market since April of this year, would I equate the dollar and the CAD to low liquidity, and especially over the past 6-7 months? No, there's been some very fast markets over the past 6-7 months. The problem is the dollar and the CAD have been both moving in the same direction. That's why we have range-bound markets. The key with foreign exchange is we look for currencies moving in opposite directions. Great question, by the way. Can you show us quickly how you got the red line for the stop order? I basically just approximated where I would place, I use a longer moving average, so to speak. Going to the Aussie dollar again, the blue line, which is, remember the lowest low, 1.0070, that's a 127 period moving average. I just added another 10, 20 points on top of that, from 127 to 140 moving average. It's just a level way to approximate. I wouldn't, take that with a hard, written in stone, so to speak. It's just a way to approximate where the stop order should be placed. Generally speaking, stop orders have to be placed below the lowest low, below the lowest double bottom pattern, or above the highest high, above the highest double top. Now, do I always start with a daily? Yes. Sometimes, though, you'll see you have to consider long-term time frames, like the dollar Swissy, which is inches away from 30-year lows, and the dollar yen, which is inches away from 1995 lows. By the way, if I miss any of your questions, please let me know. I have about 10 seconds left. I'm sorry I did not get to all these currency pairs. Let me do my best to do so. Pound dollar. Uptrending support level? Yeah, we're in a trending market condition. Really quickly, throw in our oscillators, including the RSI, Relative Strength Index. We're pretty close to 70 now. We're not above 70, so we're not extreme, but we're pretty close. Average true range, well, it's kind of choppy. Most recently, the pound dollar is moving to the upside. Throw on the moving average convergence divergence, and let's zoom in and take a look at all three. Moving average divergence actually today in the past couple of days is actually moving to the downside. The ATR is moving to the upside. The RSI is close to 70, but it's definitely not above 70, so it's not extreme. So yeah, there's a pretty significant trend in the pound dollar. I'd say the Aussie dollar is more though. And this is a great way to find the best trending currency pair. Pound dollar is a nice candidate, yeah. I think pound dollar goes up further. It would not be my number one pick though. I think there are other currency pairs with a stronger trend, such as the Aussie dollar. But yeah, it's a nice candidate. Another currency pair that I saw someone chatted in after the pound dollar was the Aussie yen, which I absolutely want to get to. Aussie yen, that's a tricky guy. Are we in a range? Are we in a trend? Well, there's a medium-term, medium strength trend to the upside. This is a daily chart. By the way, I always start with the daily charts when possible. Most recently, there's a very, very steep trend. So the support lines, it tells a little bit of a mixed story. I'm going to rely on the indicators. Indicators, number one, as I quickly run out of time here. Relative Strength Index, RSI. We're very close to 70. That's a good sign. Insert average true range. The line's moving to the upside. That's a good sign. MACD, moving average convergence divergence. That's making higher highs. Aussie yen, that's a nice sign. Now, the problem with the Aussie yen is we have this long-term former support level that suspected new resistance. So it's not a perfect world. But yeah, over the long term, Aussie yen looks not that bad at all. Let's really, really quickly go to a 1-hour chart, take away our other indicators over here, throw in a moving average to try to find a reasonable entry. There we go. By the way, we're at a suspected long-term uptrending support level. That's not bad at all. Most recent significant swing low, insert moving averages. That's under trend. This is 140. I'm just going to change the color to blue. That's 140 is too much, by the way, so I'll go to 120. 120, not enough. 130, not enough also. 135. Perfect. There we go. 135 period moving average and a 1-hour Aussie yen chart shows us the entry 81.51 right now. Of course, as the market continues higher, it will also move up accordingly. Question is to Harley: do you keep several time frames up, or just or at once 1-hour charts? I always start with the daily chart, but once I know that the Aussie yen is a good buy for the daily chart, according to the daily charts, then I'll move to one other time frame. The 1 hour seems to play a pretty important role. I can tell you that gold, even without throwing in one indicator, is very, very trendy, but we'll do so anyway, just to run through the exercise. Average true range, higher highs, that is very strong. RSI index, we're above 70. Doesn't mean we're going to stop. Shows us the market's moving very, very fast. Moving average convergence divergence, higher highs as well. That's good to go. So gold, very trendy currency pair. I figured you already knew that, but it's a great market to, not currency pair, it's a great market to talk about. Moving average, 135 moving average. I don't like this color very much. Let's go to a brighter one. That's way too long, by the way. Let's go to a 90. Not enough. Let's go to a 60. That's still too long. And the shorter the moving average, the faster the trend. That's a 40. Let's go to a 45. That's not enough. By the way, take a look at this. If we had used, let's say a 40, well, actually 42 looks better. Yeah. If we had used a 42 moving average to identify the last most recent swing low, we would have been able to get in here. Would we have gotten stopped out? If we had good stops, we probably would have been able to survive. The moving average at this point came to 1388 on gold, and we came down to lows of 1386. Yeah. So if you had used more than $2 protective stop on gold, it would have held you in the trade. But again, it's only a moving average. It's only good for for the next trade. So we have to readjust this. 45, not enough. The lowest low. Let's try a 50. That's still not enough. I'm guessing 52 might be good. Yeah, 52. 52 moving average tells us the entry for gold, 1400, large round figure. Good to go. We are out of time. But I want to thank you all very, very much for joining us. By the way, if you have any further questions, I apologize if I did not get to everybody. You may feel free to contact me directly at www.forexlounge.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see their calendar because we'll be back on with more much later. We thank you for joining us. We wish you a great day, all profitable trades. And we look forward to seeing you back soon.